Ever wondered how to unlock the secrets of the market? The answer lies in a simple but powerful tool: candlesticks. These are more than just charts. They're a visual representation of market sentiments, a treasure trove of insights waiting to be discovered. By learning to read them, you can uncover trends, anticipate movements, and make informed trading decisions. Candlesticks are an essential tool for any trader, offering a deeper understanding of the market's ebbs and flows. Ready to master the basics of candlesticks? Let's dive in. To understand candlesticks, we need to get familiar with their anatomy. Picture a candlestick as a rectangular pillar with two wicks on either end. This pillar, known as the body, represents the range between the opening and closing prices during a specific time frame. The wicks, or shadows as they're often called, show the highs and lows that occurred within that same time frame. Now let's break this down further. If the closing price is higher than the opening price, we have what's known as a bullish candlestick. This is typically represented by a filled or colored body. On the other hand, if the opening price is higher than the closing price, we have a bearish candlestick, usually depicted as an empty or differently colored body. The length of the body can give us a sense of the market's sentiment. A long body signifies strong buying or selling pressure, while a short body suggests little price movement and therefore less market enthusiasm. Moving on to the wicks, these thin lines play a vital role too. A long upper wick on a candlestick indicates that buyers pushed prices up during the time frame, but sellers managed to pull them back down. This could suggest a potential future price drop. Conversely, a long lower wick shows that sellers drove prices down, but buyers pushed them back up, hinting at a possible future price increase. However, be careful not to base your trading decisions on a single candlestick. It's like trying to predict a movie's plot from one scene. Instead, consider the bigger picture by observing candlestick patterns over time. It's also worth noting that while candlesticks can provide valuable insights, they are not foolproof. They should be used in combination with other technical analysis tools to increase the probability of successful trades. Now that you understand the basics, let's move on to recognizing key candlestick patterns. Recognizing patterns in candlesticks can give you a competitive edge in the market. Each pattern tells a unique story of market sentiment, and understanding these patterns can provide valuable insights into potential market movements. Let's dive into some key candlestick patterns that every trader should know. First up is the long upper wick. This pattern is characterized by a long upper wick and a small body at the bottom. It's like a candle that's been mostly burned down, leaving a long, thin remnant of wick. This pattern suggests that during the trading period, prices were driven high, but sellers came in and pushed the price back down. This can often indicate a reversal of an uptrend. Next, we have the long lower wick. This pattern is the opposite of the long upper wick. It has a long lower wick and a small body at the top. This pattern tells us that despite sellers driving prices down, buyers stepped in and pushed the price back up. This could signal a reversal of a downtrend. Then there's the spinning top. This pattern has small bodies with long upper and lower wicks, resembling a spinning top toy. The spinning top indicates a tug-of-war between buyers and sellers with no clear winner, which often signifies market indecision and potential reversal. Lastly, we have the doji. The doji is a very unique pattern. It has the same opening and closing price, resulting in a very thin or non-existent body. The doji represents a perfect balance between buyers and sellers and often indicates market indecision. A doji after a prolonged trend can be a strong signal of a potential trend reversal. It's important to remember, though, that these patterns are not foolproof. They're tools to help you better understand market sentiment and potential price movements. They should be used in conjunction with other technical analysis tools and not as standalone indicators. And remember, the longer the time frame, the more significant the pattern. It's also worth noting that candlestick patterns can appear anywhere on the chart, not just at the top or bottom of trends. So, keep your eyes peeled and always be ready to interpret the story they're telling. Once you've mastered these basic patterns, you're ready for some advanced insights. But remember, practice makes perfect. So take the time to study charts, identify these patterns, and understand what they mean in different market contexts. The more you practice, the better you'll get at using candlestick patterns to make informed trading decisions. And that, my friends, is the key to getting a competitive edge in the market. Ready to dive deeper? Let's explore bullish and bearish engulfing patterns. These patterns play a crucial role in predicting market reversals, so buckle up as we delve into the details. First, let's understand what an engulfing pattern is. Essentially, it's a two-candle pattern that occurs when a small candle is followed by a larger one, completely overshadowing or engulfing the previous candle. The color of the engulfing candle, whether it's green or red, determines whether it's a bullish or bearish engulfing pattern. Now, on to the bullish engulfing pattern. This pattern occurs at the end of a downtrend and signals a possible reversal to an uptrend. Picture this. You've got a small red candle, signifying a bearish market, followed by a larger green candle that completely engulfs the previous one. This is the bullish engulfing pattern, and it suggests that the bulls have taken over the bears, potentially leading to a price increase. On the flip side, we have the bearish engulfing pattern. This pattern is the exact opposite of the bullish engulfing pattern. It's spotted at the end of an uptrend and signals a possible reversal to a downtrend. Here, a small green candle indicative of a bullish market is followed by a larger red candle that entirely engulfs the previous one. This suggests that the bears have now taken control from the bulls, and a price drop may be on the horizon. So, how can we see these patterns in action? Let's take a look at some historical data on a Bitcoin chart. As we move along the timeline, you can spot instances where bullish and bearish engulfing patterns have formed. Notice how these patterns often precede a change in market direction? That's the power of understanding these patterns. However, remember, no pattern is a guarantee of what will happen next. They're just tools to help us make educated guesses about the market's future direction. It's also crucial to consider other factors like market conditions, news events, and your overall trading strategy when making decisions. Engulfing patterns are a valuable addition to your trading toolkit, providing insights into potential reversals in the market. By understanding these patterns, you'll be better equipped to anticipate changes in market direction and make more informed trading decisions. Now that you're familiar with these advanced patterns, let's talk about how you can apply this knowledge. Knowledge is power, but it's how you use it that counts. So, you've learned about candlestick patterns, their significance, and how to identify them. Now let's delve into the practical side of things, integrating this knowledge into your trading strategies. First and foremost, it's essential to remember that candlestick patterns aren't standalone signals. They're part of a broader narrative, a piece of the market puzzle. So when you spot a pattern, don't rush into a trade. Instead, consider the bigger picture. How does this pattern fit into the overall trend? What other indicators are suggesting a similar sentiment? And here's another crucial tip. Focus on the logic behind the patterns rather than memorizing them. Sure, you could memorize 100 different patterns, but without understanding the market dynamics they represent, you'll be navigating blind. For instance, let's take the bullish engulfing pattern. It's not just a random sequence of two candles. It's a story of market sentiment shifting from bearish to bullish. It's buyers taking control after a period of selling. Understanding this story makes the pattern more meaningful and helps you make informed decisions. Lastly, always remember to manage your risk. No pattern, no matter how reliable, guarantees a profitable trade. So use stop losses and don't risk more than you're willing to lose. Remember, understanding the story behind the candlesticks can significantly enhance your trading decisions. Let's quickly recap what we've learned today. We started off by introducing the concept of candlesticks, a powerful tool that reveals market trends and sentiment. We delved into the basics, understanding the significance of a candlestick's body and wicks, and how they can tell us a story of the market's behavior. We then moved on to key candlestick patterns. Remember the long upper wick, long lower wick, spinning top, and doji? These patterns can provide crucial insights into market conditions, helping us anticipate potential shifts. Next, we took a deep dive into advanced insights, exploring bullish and bearish engulfing patterns. These patterns can signal a possible market reversal, offering opportunities for strategic trades. Lastly, we discussed how to integrate this candlestick knowledge into your trading strategies. Remember, logical analysis trumps memorization of patterns every time. It's about reading the market's narrative, not just recognizing shapes. So what's next? It's time to take this knowledge to the trading floor. Practice makes perfect. So start analyzing real charts, look for patterns, and test your insights. Remember, every candlestick tells a story. Your job is to understand that story and use it to make informed trading decisions. Liked what you learned today? Hit subscribe to stay updated with more trading essentials.